When you think you don't have money to invest in real estate, think again. You may have more money than you realize. Let me share this big secret with you. Most people are not aware that they can use their 401k to invest in real estate. Not only that, some financial advisor may even say it's illegal to have control of your IRA. In this episode, I invited Haley Gant with Quest Trust to talk about how you can invest in real estate with your 401ks, your IRAs, or other qualified plans. And what really amazing is, well, stick around and Haley will share that with you. Hey ballers, welcome to episode 105. Today we're going to talk about investing wisely with your self-directed IRAs and keep Uncle Sam out of your pocket. With me is Haley Gant with Quest Trust. Hey Haley, welcome to the show.
Hey V, yeah, super glad to be here today. I'm glad I get to join you on this.
Yeah, I'm very excited for what we're going to talk about. So, what are you working on today?
Oh, yes. So I know by the time this airs, it will be the beginning of the year, but we are right here at the end of the year, kind of, getting all of those end of the year things wrapped up. For those of you guys who don't know me, my name's Haley. I'm with Quest Trust Company. I'm one of our IRA specialists in our marketing department. So my big focus is on our business development, developing our education and webinars, and really just making sure that we can provide the best education to our clients as possible as we move forward into 2021. So that is a huge project right now. Personally, I'm also finishing up an Airbnb to hopefully have ready by the beginning of the year here with my boyfriend. So yeah, I guess you could say that we are staying very busy right now.
Oh, wow, you are keeping yourself busy. Well, so one thing about Quest for the audience who don't know, you guys are really, really big into educating people. And
Mhm.
so I love to have you on the show today. That's one of the reasons. So anyway, can you tell the audience a little bit about yourself?
Yeah, definitely. So, again, my name's Haley Gant. I'm an IRA specialist at Quest Trust Company. I'm based out of Houston here locally. It's kind of where I grew up. But I've been with Quest since June of 2016. So, almost 4.5 years now. And in that time, I've lived in Houston, I've lived in Dallas, and now I'm back in Houston where our corporate office is. And, I've really gotten to travel around a lot, pretty much all over the country, getting to educate investors about self-directed IRAs, which is really cool because, V, as you know, I've actually grown up around real estate my entire life. My parents, when I was in kindergarten, quit their corporate jobs, went to Vegas for the weekend, and on Monday, they started investing in real estate. That was like 1,700 houses ago. They're also hard money lenders. And I'm an only child. So I had no choice but to grow up surrounded by everything real estate. I actually learned about what a self-directed IRA was back in high school. And to
Yeah.
be honest, I really didn't care. I really didn't understand why it was so beneficial. And here I am, like almost 10 years later from that point in time, and I'm teaching investors about how to do this every single day. So it's a lot of fun. It keeps me busy. I feel like I've really grown up with Quest since I've graduated college, and it's really awesome to be able to, have opportunities like this to educate investors over topics that they might not get that really high quality education on every day. So,
I actually been talking to a lot of investors lately in
mhm.
different field of real estate investing. And it's amazing that so many people still have no clue about what we're going to talk about today, like
Yeah.
about IRA, how to take advantage of these plans, for their
Hmm.
family, their kids, or themselves. So thanks for sharing your background with us.
Hmm.
You
Yeah,
know,
definitely.
that's really fascinating, like how you grew up in real estate and you find
Mhm.
yourself in real estate.
Yeah, it's really awesome. It's almost like second nature. And that was one of the really cool things whenever I started at Quest. I kind of got recruited basically right out of college. My parents have also been Quest clients since like 2004. So Nathan, Quincy, our founders, they've known me since I was really little, apparently. Um, but yeah, it's been really cool. And I already knew all the real estate stuff. So just add on IRAs on top of that. And then when you realize what such a powerful resource it is for people, and like you were saying, almost nobody knows about it, or not a lot of people know about it. It's really cool to kind of have found this niche where I'm not just selling a product, I'm adding value to people's lives as we go out and we teach about these sorts of things.
Well, so for the people that are the audience that are listening or watching, don't underestimate Haley. She might look young, but I can tell you she has the knowledge of 50, 30, 40,
Yes.
50 years of real estate.
Oh yeah, definitely.
So of course today we're talking about retirement plans and IRA and whatnot. Maybe specifically about the self-directed IRA, but maybe
Mhm.
can you briefly go over the different type of retirement plans that can be used in real estate?
Oh, yes, definitely. So, this and to kind of back up for a second. So, as I was mentioning, Quest does a lot of webinars, and we have 7 different types of accounts that can be self directed at Quest. In all of our webinars that we teach, we actually always touch on the types of accounts in the beginning of almost every presentation that we do, because it really is the core of understanding the types of accounts that can be self directed, their various benefits, and then how you can use multiple different IRAs together. So at Quest, we actually have 7 different types of accounts that can be self directed. Now, if you have a 401k through your employer and you're still currently employed there, there's a good chance you're not eligible to move those funds just yet. But, outside of that 401k, any IRAs that you have are completely independent of any 401ks or employer plans that you might have associated with your job. So at Quest, we hold personal plans, traditional IRAs, Roth IRAs. If you are self-employed, we have some employer plans like the really popular solo 401k. Also, SEP IRAs are really popular to be self-directed. And definitely, last but not least, not to be overlooked, are the specialty plans, as we like to call them. These are really valuable. And I hope we get some time to talk about these today a little bit. But the health savings account and the Coverdell education savings account are really awesome because they can be self directed, just like all of our other IRAs at Quest. But the money can actually be used today, completely tax free, to pay for any of your qualified health expenses for you and your family, or even qualified educational expenses for your children, grandchildren, whoever you maybe choose to set up that account for. So there's a lot of different types of accounts that can be self-directed. They all technically are self-directed IRAs. So self-directed is really just a marketing term. It's not actually the specific type of account, but where it really comes into understanding which types of accounts you might qualify for, how much you can put in, which one might be best for you right now. Reach out to us one on one, talk to an IRA specialist. Like anything in life, it's so much more difficult when you try to go about it alone, try to do it yourself. We have pretty extensive training internally for our IRA specialist. We are actually trained to ask you certain questions whenever you call in and are ready for this consultation. So yeah, 7 different types of accounts. They all have various tax benefits. And I'm sure we'll probably get into a few more of them as we continue through the show.
Let me ask you a dumb question. Did you say the 401k can be self-directed as well?
Yes. So a solo 401k can be self directed if you are like self employed. If you don't have any W 2 employees, then you do qualify for that plan. But if you have like a 401k through your employer, if it's from a previous employer, which, gosh, guys, after 2020, there's a lot of 401ks out there that are now eligible to be rolled over into an IRA. So that could be rolled over into an IRA at Quest, where you have the ability to invest it into real estate, notes, other types of privately held assets. Or, if you did go the more traditional route, you could roll those funds over to a place like, I always use Fidelity as an example. It could really be any of those institutions. They allow you to invest into stocks, mutual funds, publicly traded securities, where at Quest, our clients use their IRAs to invest into privately held assets. A lot of our clients have IRAs at both types of companies, and I'm probably getting way off track right now. But yeah, 401ks, once you leave that job, you are eligible to roll that into an IRA. And no matter where you put your money, you want to make sure you understand what you're investing in and that you are, truly diversified in your investments, which is why having a self-directed IRA is such a great option for so many Americans out there.
So that actually lead me to the next question is, so we talk about all these amazing plans, okay? So let's talk about what are some of the types of real estate investment that we can use these plans for.
Yeah, definitely. So, pretty much anything that you can hold title to, you can hold title to in an IRA. There are actually only two things that the IRS explicitly states that you cannot invest in with an IRA, and that is life insurance contracts and collectibles. Other than that, you can hold all sorts of assets in your IRA. We kind of break it down into three different categories. Um, to be honest, the most popular option that we see at Quest is private lending. So we see a lot of investors that like to use their IRAs to be 100% completely passive and either purchase existing notes or maybe be a private lender and loan funds out to other investors. So we see that a lot. We see a lot of individuals who hold the actual physical real estate in the IRA. So you could literally buy a rental property in an IRA and potentially never pay any taxes on that rental income that comes in, over the course of that investment back to the IRA. And there's no capital gains taxes in an IRA as well. So that's a really popular option. And last but not least would be private placement investments. So we see a lot of people that, again, completely passively invest their IRAs into apartment complex syndications, multifamily deals, commercial deals, startup companies, pretty much whatever you choose to invest in. Remember, it is 100% self directed. You get to choose the investments for the IRA. There are some restrictions. I'm not sure if we have a question to get into those, but really important to designate. You can hold title to all sorts of things in your IRA, but your IRA gets really awesome tax advantages to help you save for retirement. So, therefore, the IRS does not want you using your IRA to do an investment that directly benefits you right now. So, you couldn't use your IRA to invest into your own business. Or if you already own a property and say that property needs a new roof, you can't just use your IRA to fund into your deal that you already own. But,
But
and
you can partner with your IRA, correct?
you
Okay.
can. Yeah, yeah. So any like new investments that come along that aren't directly benefiting you or certain members in your immediate family. But yeah, partnering is such a great option. We see so many people that partner their IRAs. It's actually how I grew my own Roth IRA. I actually partnered my IRA with my mom's Roth IRA for a couple of different fix and flips. And my IRA was pretty small. It literally owned 8 to 10% of a couple of different investments that we did. And my mom's IRA was partnered in. So we divided up the percentages of ownership and hers owned the rest. She's got a much larger IRA. She's been investing much longer than I have. But just from those few deals, my IRA almost like tripled in size. And now I have, 27,000 to work with instead of 11,000. So, kind of diverging once again. But if you have a small amount out there, don't limit yourself by saying, I don't have enough to invest. Just find ways to utilize creative investment strategies for that amount that you do have in your IRA. And partnering is a really popular option that we see. Like you were mentioning, you can also partner with yourself. You just really want to make sure if you are doing that, that you are keeping track of the percentages of ownership and everything is split evenly based on those percentages of ownership, whether it's multiple IRAs on the deal, you partnered with your IRA. Again, totally up to you, however you choose to structure it. But you want to make sure, call Quest. We'll walk you through the rules. We'll kind of keep you in line with what you need to do. We can't tell you how to structure your deal, but we can tell you what's allowed and what isn't and kind of let you go from there.
That's exactly what I do when I have a question on
Hmm.
my IRA.
Yes.
Did you also say that we could buy notes in our self-directed
Yeah.
IRA?
Oh, yes, definitely. So notes is so popular these days. I feel like I keep saying that, but it really is like private lending, purchasing existing notes. Because the reality of it is when you are investing with a self-directed IRA, you need to keep things arm length from yourself and your own personal investments. When you're just using your IRA to be completely passive, maybe purchase existing notes, whether it's performing or non performing, there's typically like a note servicer in place there. It makes it really easy to self direct your funds, but still keep it at arm's length and be completely passive there. And it's really funny because actually anytime that we bring in guest speakers to our classes and they teach about notes, we get almost triple the attendance as other topics that we teach about. So, it's a really popular option for not only investors but self-directed IRA investors. We see a lot of note investing.
Let's go on to the next questions of,
Yeah.
so we know the type of plants and we know what we can buy with those
Mhm.
plants. First is, do you fund these accounts just like you would fund a regular IRA accounts or
Mhm.
whatever retirement accounts that you have?
Yes, definitely. So, again, like technically speaking, our accounts legally are exactly the same as any IRA that you might have at any other custodian. Really, the only difference is the types of assets that we actually allow you to invest in, compared to most of your own traditional custodians. So, you can fund your IRA from a few different methods. If you're starting out brand new, you maybe don't have any retirement accounts, maybe that 401k is not eligible to be moved yet, you can definitely start your IRA by making a contribution. Now, a contribution is like from your own personal funds that you put into the IRA. That is limited each year. For a traditional or Roth IRA, it's $6,000 a year or 7,000 if you're over the age of 50. So they give you a whole extra $1,000 to catch up at that point, basically. But this is again really where that consultation really comes into play because those are only two of the seven different types of accounts that can be self-directed. So we always like to ask our clients, do you have self-employment income? Because if you have self-employment income, the three employer plans that we offer, mainly two, what most people choose between, the solo 401k and the SEP IRA. The third one is the simple IRA, but it's not as common to be self-directed, to be completely honest. But these employer plans allow for much larger contributions. For 2020, potentially up to $57,000 based on your income that you're paying yourself out of your business. And for 2021, it bounced up just a little bit more to $58,000. Again, meet with an IRA specialist, visit our website. We have the exact kind of way those contributions break down there. Don't want to spend too much time on that here because we can talk about that one on one later. But yeah, if you don't have any plans, you can make contributions. If you have a 401k from a previous employer, that can be rolled over into an IRA. But we also see a lot of people that maybe currently have IRAs at more traditional custodians and just transfer some of those funds over to Quest. Now, you noticed I said some of those funds. It doesn't necessarily have to be the full IRA. Remember, you want to make sure that you are keeping your funds working, you're keeping them diversified. So, a lot of our clients might just move over to Quest what they intend on self directing. If you're doing that, I always tell people just make sure you understand the time frames, how quickly or how slowly your current custodian can send us those funds once you're ready to do a deal. Typically 1 to 2, maybe 3 weeks, just kind of depends. But we see a lot of people do that. And the nice thing about transferring funds back and forth from one IRA to another is that you can do that at any time. Those transfers, to be honest, are not even reported to the IRS because they're never actually leaving an IRA. They're just going from one custodian to another, staying in the same type of IRA account. So, those three methods really, really common. Also, there is kind of a fourth somewhat method. This is something that I really like to talk about again. But if you are looking to open up a Roth IRA, which I firmly believe that everyone out there should have a Roth IRA because it grows completely tax free. Whereas most of your 401ks, traditional IRAs, you do have to pay taxes later once you take the money out.
So let me pause you on that, and I
I'm
have
just
some
like going,
questions for you.
yeah.
I have some questions for you on the Roth.
Yeah. Yeah, let's get
So
into it because I love the Roth
yeah,
IRA.
so I'm a big believer in the Roth IRA. I have
Yeah.
A self-directed Roth IRA myself
Yeah,
because I believe in tax-free now and tax-free later.
exactly.
So first of all, can an individual have a 401k and a Roth at the same time
Yes, you
and a
certainly can.
traditional IRA?
Yes. So there's no
Okay.
limit as far as the number of IRAs that you have. Just kind of overall for the year, you can't max out your contributions to each Roth IRA that you have. Overall, if you have like 3 Roth IRAs, it's the same contribution limits, but There's no limit as far as how many IRAs or 401ks an individual might have.
Right. Okay. In your IRA, because it's self-directed, if you're not doing anything about it, you may not have any gains. That's
Exactly.
the big
Yes.
difference between having it with a traditional custodian where they invest in
Hmm.
bonds, stock, and whatnot.
Yes.
So it may
Mhm.
be a good idea to diversify, maybe have some, like you said earlier, partial in one account and then some in the other. So they both
Mhm.
working.
Exactly. Yes, because you want to make sure, your money's working and something, we're very transparent about it. If you have $1 million in an IRA, but you're only ready to self-direct 100,000 of that, you want to keep the other money working. Just move over what you need to Quest to do the investment. Then again, if you want to do another investment, just do another transfer. We even see a lot of people that maybe if they get like quarterly payouts from their like private equity investment that they
Mhm.
have with their Quest IRA, they might even transfer that little bit just over to their more traditional IRA custodian, just so it's continuing to grow. We don't really charge anything for that, because we understand that our clients are savvy. They want to keep their money working. So, we really do everything in our power to make sure that we take care of our clients in those types of ways.
All right. Thank you.
Mhm.
Now let's talk about the Roth and the
Yes.
traditional. Okay.
Hmm. Yes. So I'm getting way ahead of myself. It's so funny with COVID. I don't get to go and speak in front of as many people as I quite used to. So now when I get to do presentations, it just all comes out at once.
You're
Um,
doing wonderful.
yeah. So traditional IRAs and Roth IRAs, again, are both considered personal plans. But the only difference between these two accounts, they can be invested in exactly the same way. But your traditional IRA grows tax deferred, where typically, when you make a contribution to a traditional IRA or to your 401k, you get some sort of tax deduction. So that money is considered to have not been taxed yet. It grows tax deferred. So you don't have to pay any taxes until you actually take out your distributions later at retirement. The original thinking behind that was when you're in your working years and you're putting money away, you get tax deductions. Then, when you're retired, and ideally at that point, you're in a lower tax bracket, at that point, that's when you pay taxes when you take the money out.
Right.
But it doesn't always work like that. Also, as a real estate investor, I probably don't plan on being in a lower tax bracket. I plan on
Well, I
continuing
want to
having
make
my
more
streams of
money.
income,
Yes.
right? Yeah, exactly. So the Roth IRA is the exact opposite, where whenever you make contributions to a Roth IRA, you don't get any sort of tax deduction after tax dollars that you put into that account. So everything else that grows from there is also considered to have already been taxed. As long as you leave all of the growth and the profits in that Roth IRA until you're 59 and a half and you've had that Roth IRA for 5 tax years, those are the two qualifying events to have absolutely everything in that Roth IRA be completely tax and penalty free, for not only your life, but eventually when you do pass on and you pass on that Roth IRA to your heirs, they inherit that money also completely tax free. So it's a great way to pass on that tax free wealth to the next generation. But one thing I always like to talk about here with, traditional IRAs, Roth IRAs, the reality of it is most Americans, their retirement plan at some point came from a 401k. So most Americans' retirement money is growing tax deferred.
Mhm.
For the average American, it might not make sense to move those funds into a Roth IRA because their IRA is really not growing that fast, to be completely honest. But for real estate investors out there, our president Nathan Long, he goes, "We are not average. We think differently." So we, with investing our IRAs into non-traditional assets such as real estate, you really have the potential to grow your IRA much larger maybe than the average American might be able to, because you're utilizing these creative investment strategies. There is something that you can do called a Roth conversion, where basically you can move funds from a traditional IRA or a 401k into a Roth IRA. Whenever you do this, you pay taxes on whatever amount you move into the Roth. But say you do a $10,000 Roth conversion this year, you're going to pay taxes on that $10,000. But then if you invest and you grow that Roth IRA to $1 million, you now have taken advantage of all of that growth completely tax free. So, whereas if you take that $10,000 in a traditional IRA and you grow it to a million, you don't actually have $1 million because that money hasn't been taxed yet. It's a huge wealth building tool. It's something that I recommend everyone look into. And this is my last point on this question, but even if you are a high income earner, because we get this question all the time, if you have a really high income, you can't make a contribution to a Roth IRA, but you can still do a Roth conversion. So everyone out there can have a Roth IRA. It just kind of depends if you want to make the contribution or do the conversion, but it's such a powerful tool. I would recommend everyone out there get a Roth IRA open this year, at least get some money in there and get it working so you can really take advantage of that tax free growth.
Earlier, you said for the high income earners. Are you able to tell us what that limit is?
Yes. So if you ever want to look these up, they are called phase out limits. Like you get phased out essentially from being able to make the contribution. To be honest, they kind of change every year. I believe if you are single, filing single on your taxes, if your income is over around 120 to $130,000 for the year, at that point you are now phased out of being able to make a direct contribution to a Roth IRA. Now, if you are married filing taxes jointly, that goes up to around 180,000 is when you start to get phased out, up to around 193,000 I want to say. That is when you're fully phased out of being able to make a contribution to your Roth IRA. Again, that second one is if you are married filing jointly. But these slightly change every single year. If you guys want to know the exact phase out limits for 2021, you can Google them very easily. Just Google Roth IRA phase out limits. To be honest, I have to Google it all the time because they slightly change every single year, just kind
Okay.
of based on inflation, things like that. But yeah, they're very easy to find. If you guys can't find it, just call me.
So we got through the technical part of it. Let's get maybe into the fun part.
Yeah,
You can
it's all fun.
share,
What are you talking
yeah.
about? I love IRAs.
The fun part, the where we, if you can share some of the real life example of how the
Yeah.
investors use their self-directed IRA
Mhm.
to,
Yes.
accumulate wealth.
Yeah, definitely. So I do have a few examples that come to mind.
This episode is brought to you by Buzz Vacation Rentals, a premier property management company in Houston and Galveston area. Give Buzz a call at 281-549-8432 to learn more about their rent guarantee program, or check out their website at listwithbuzz.com. Now, back to the Real Estate Baller Show.
Quest actually hosts about quarterly Battle of the Case Studies events. They are super fun. They're all recorded on our Facebook and YouTube page, but we do bring out real clients to teach their case studies pretty frequently because you guys love to hear that. There's only so many times you want to hear me explain basics of self-directed IRAs. So we do teach a lot of real client case studies. One in particular that always stands out to me, this was back when I was kind of new at Quest, and this client came in, she was opening up her first Roth IRA, and she made a contribution of $5,000 to this Roth IRA. If you guys know, like Nancy Wallace Labs up in Dallas, she's presented this at a few of our events, but she literally made a $5,000 contribution to a Roth IRA and then partnered with another individual that she knows and, reputable. They'd done their due diligence, things like that. They found this old, ugly, rundown property in Fort Worth, literally bought it for $10,000, partnered the IRA. So the IRA owned 50%. So the IRA's initial investment was $5,000. And then within a month of them purchasing this property, they owner financed it out. I don't remember the exact terms of the deal, but I want to say they owner financed it out for like, I don't know, not too much, but over the course of this investment, over the next 15 to 20 years, from an initial $5,000 contribution, less than a month's work of their time, that Roth IRA is going to get back $45,000 when you compound the payments, the initial down payment that went down, and then over the course of owner financing, that IRA is going to get mailbox money for the next 15 years, totaling, if it pays off over the whole loan, $45,000. It is awesome. I love that example because there's never too small of an amount. Another example that
Good
I'll give a
mailbox
private
money,
lending.
right?
They
Good
what?
good
Yeah,
mailbox money.
definitely. Yeah, that's the best type of money, right?
Yeah.
Um, and just to kind of use like a private lending example, even like a lot of our IRA specialists will actually partner our IRAs together and loan out our funds to other investors. So we'll see a lot of people. Maybe if I have like $50,000 in an IRA and V needs $50,000 to buy a property, I can actually use my IRA to be a private lender to V. We go out, we get the promissory note drafted up, we get the deed of trust drafted up. All of these documents will show my IRA as the lender and then V, or likely V's LLC as the borrower. So we basically send those documents to Quest, and our transactions team is going to look it over to make sure that the IRA has been titled correctly. Me, as the IRA account holder, I have to sign off on these documents, basically authorizing Quest to sign off on that point on the behalf of my IRA. The total turnaround time for this is pretty quick on our end. Once we get everything that we need, 24 to 48 hours, we'll have that deal funded. V will have that money wired to her pretty quickly at that point. And then me, as the IRA account holder, I actually have a login to our online client portal. And so I can see my investments, I can upload my documents, and I can actually check in there and make sure that V is making her payments on time every month, since she's the borrower and my IRA is the lender in this case.
So
But
the
yeah.
IRA is the lender. The
Mhm.
loan is secured by the property, the asset,
Yes. If you structure it properly,
right?
yes. Yes.
And you close through a title company.
Mhm.
It's highly recommended, right? You
Ideally,
don't have
yes.
to, but highly recommended. And you can also partner up with other people or other
Mhm.
IRA accounts to
Yes,
be the
definitely. And
lender.
and let's touch more on that for a second
Yeah.
because we've touched on partnering a little bit, like your own IRA, your other IRAs, or your own funds. But where we see partnering to be really popular is, the reality of it is most families don't have all of their IRA funds in one account. It might be like the husband has an IRA, maybe the wife has an old 401k, maybe their children are teenagers and now have jobs, so they've started their own Roth IRAs. If you partner all of those IRAs together to be a private lender, it's a really easy process. The borrower just makes one payment back to Quest. And then once Quest receives that payment, we can see which asset it's related to. And we can kind of divvy up the payments to each IRA based on those percentages of ownership. So a lot of families out there that have multiple IRAs will partner them together so they can kind of get a total aggregate of the funds and then do the investment from there. Because most families don't have all their funds in one account. Most times it's split between several different accounts, especially if they're small. Partnering is a great way to go.
Yeah, it is really good for both the account holder and the investor, real
Mhm.
estate investor. Because in
Exactly.
my I've actually have done that several times. You know,
Yeah,
uh,
nice.
using the loan from Quest
Yeah.
clients.
Mhm. And let's touch on that for a second because in all of our presentations that we do, there's really kind of like two sides to what we do at Quest. There is your own retirement, building your buckets of money for your future, but there's also the ability to utilize other people's IRAs as private lending sources for your deals. So if you're an investor out there and you're actively looking for private money, maybe you don't want to pay all those hard money lending fees anymore. You've got some deals under your belt.
Need
Equip
to buddy
yourself.
up with someone with an IRA,
Exactly.
several
It's
someone.
Yeah, it's so important to equip yourself with a basic overview of how this works because it could potentially open up a lot of doors to private money for your deals because most Americans out there are not satisfied with their returns in their retirement account. They're tired of it going up and down. They want something steady, they want something secure. And so, if you as a real estate investor kind of know how to go out and introduce that conversation to people, you could really potentially open up a lot of doors to private money. And my piece of advice, just know when to loop in Quest on the conversation. We are always completely neutral. We're not here to push someone's investment. So a lot of times we can come in and really provide the technical education, the portability, how the funds move, the taxes, things like that. Instead of you having to know everything that an IRA specialist knows, you just go out, do the networking, find the people. We'll do the rest of the education from there.
Yeah, you guys really got your process down. Uh,
Yes.
Um, what about, have you had clients that use the IRA to do assignments in?
Yes. So this is a bit of a touchy subject, like assigning, wholesaling, in an IRA. We definitely see people do it, but it is something that you probably don't want to just do a whole bunch of times in an IRA because it could be seen as one, running a business in the IRA because, you're no longer just investing. You're actually like providing a service. If you're wholesaling, if you're assigning contracts, that's not really an investment. That's really you doing a lot of work and then kind of funneling the money into your IRA. So it's a little controversial. We do see people do it because, who's to say that you didn't get this property under contract with your IRA and someone else came along and wanted to buy it. And you, as the fiduciary to your IRA, just did what was in your IRA's best interest and maybe assigned it out from there. So, a little controversial, but we have seen people do it where, instead of assigning the contract, they maybe will actually purchase that property with the IRA, then just turn around and sell it to someone else because maybe they were able to get it for a really good deal initially. So we see people do it both ways.
Just for the audience who are listening, an assignment is when someone sells their interests to the property. They have a contract to buy the property, but they're not closing on it, and they go and sell it to someone else at a higher price. So
Mhm.
the difference is the assignment fee. And if you use your IRA to buy the property, then your IRA will get that assignment fee. And the benefit is you don't have to pay tax, income tax.
Exactly. Yes. Yeah. Again, just want to be wary, because some things that might raise a red flag is, if you take $100 in an IRA and you say wholesale like 50 properties in the IRA in 1 year and you grow that $100 to like 200,000 strictly by assigning contracts, that's not really investments in your IRA. You're providing a service, you're running a business. You want to make sure that with your IRA, the penalties can be really high if you get yourself into prohibited transactions. So it's better to play it safe, play it by the rules. If you're doing something that's in a gray area, maybe just do that investment with non-IRA funds. That way you don't have to worry about the restrictions that come into play with, certain family members, certain types of deals you might be looking to do. But again, give us a call, watch our other classes. We go into that. I don't want to get into all of that.
Yeah, I
Things you
know you
can't do.
guys.
Yeah, we'll do
Yeah,
it later.
there's a long list of prohibited transactions and things
Mhm.
you shouldn't do, but we're not going to go over that today.
Yeah.
If the audience wants to find out, they can contact Quest or
Exactly.
go do their research on those items.
Mhm.
So let's I got a couple more questions. So what are your thoughts on the checkbook control of your IRA?
Ooh, yes. Always a hot question. So checkbook control, again, another, people have different views on it. And our views, and there's actually two attorneys that we work with, John Heyer, Jeff Watson, probably two of the most renowned attorneys in the self-directed IRA space. Um, they are also not overly fans of checkbook control. With checkbook control, basically how that works is you basically uh, start an LLC. Typically, there's a company out there that will charge you a couple $1,000s to sell you this type of setup and not really teach you about it. So be wary of that. But basically, you open an LLC that you're the managing member of, that your IRA then funds into. So you're acting as your own managing member of an LLC that your IRA has funded into. Now, in any other circumstance, this is considered a prohibited transaction. There's actually a court case that I guess like set the precedent for this. First of all, this court case took place in 1995. I'm sure you can imagine how much has changed with the popularity of self directed IRAs since then. It's called Swanson versus Commissioner. If any of you nerds out there want to look it up, it's some nice light reading for you. Um, But basically, they didn't really go after the real issues in this case. The real issues with checkbook control is that you are providing a service to your IRA. So we see these accounts get audited at higher rates. There's a lot of people out there that have been sold these types of accounts that have not been properly educated over what the rules actually are when you're investing with a self-directed IRA. So just for, those reasons and a few other things kind of combined together, Quest does not hold control. The only type of account that we have that you would get checkbook control is the solo 401k, because at that point, you're actually acting as your own trustee of your own solo 401k plan. It functions much, much differently. But, checkbook control, there's people out there that will sell you that sort of setup. We do not hold it at Quest just because we foresee that it will become problematic in the future. And, there's just a lot of people using those accounts, how they probably shouldn't be, maybe doing things that are prohibited. So we like to stay away from that. And we really like to educate, about the potential dangers of it, things like that. At the end of the day, it's up to our clients to make their own decisions. But what we find a lot of times is when someone calls us and they want checkbook control and they talk to us and they maybe don't get the exact answer that they want, but then they call other custodians, they find that the representatives that they talk to are not near as educated as the information they were able to get from us. And a lot of times, even if it's not initially how they really wanted to do it, they might end up coming back to Quest just because we were able to provide the most expertise on the topic. So you want to make sure that, especially when you're dealing with your retirement, how long have you worked your entire life to save up this money? You want to be smart with it. You want to be safe. You want to make sure you're structuring things properly. And you want to make sure that you're working with people that are educated in the types of things that you are looking to do. So, yeah, that's my take on checkbook control. Again, it's we could really get into the weeds in that. There's other court cases. We've actually done several extensive internal trainings with some of the attorneys that we know, just so our IRA specialists can kind of stay on that cutting edge of, where we're at with things like that.
So the short answer is you can do it, just have to make sure you know what you're doing.
Exactly. Yeah.
Yeah,
And understand the dangers that could potentially come with it.
yeah,
Mhm.
yeah. What are some other example of how people grew their IRA?
Mhm. Um, yeah, so gosh, there's a lot of them. We see a lot of people, especially lately, like here in Texas, we've seen a lot of passive multifamily syndications. So, we work with a lot of multifamily investors. And again, this is where it kind of comes into having a good education of not only how you can invest your own IRA, but also how you could potentially raise capital from other people's IRAs. Because, a lot of these big commercial multifamily syndications that we see, basically they raise private capital to cover their down payment for this like large multifamily property, and then they get a non-recourse loan for the rest. Well, a lot of this private capital that gets raised for these syndications comes from self-directed IRAs. So, again, completely passive. There are some things to be aware of there if you are investing passively into multifamily syndications like uh, UBIT, unrelated business tax, things like that. Let's not open that can of worms today, though. I do several other classes over UBIT. I'm a UBIT nerd. I love it. Call me later. We can talk about that. But yeah, we see a lot of multifamily syndications, the private lending, direct holding of real estate. We've seen a lot of people that buy properties with their IRA and then, kind of like Nancy did, owner finance them out. I always like to tell people, think of the investment that you're doing. When do you really need the payout from this investment? Is it now? Maybe don't do that investment in your IRA if you really need that capital now. But if you don't need it now, do the investment in your IRA, let it grow up, let it build, compound on itself in your IRA, so like for example, Airbnbs. Always like to use Airbnbs for an example. We see people do Airbnb in an IRA, but personally, I wouldn't overly recommend it because there's a lot that's involved from, the owner's end of owning that Airbnb property. If you own a property in your IRA, you cannot personally benefit from that property. You can't go stay there on the weekends. You can't go take a vacation there with your family.
Oh, really?
Nope. Nope. Sorry to big letdown here, but it's my favorite example because, Airbnbs, I would not do that in my IRA because if I have an Airbnb, for example, we actually do have one on Lake Conroe. It's on the water. It's so nice. I want to go stay there. So I'm not going to buy that investment in my IRA because I don't want to deal with those restrictions. But other investments, like maybe, seller finance properties, private lending, investing into other people's deals, we see a lot of people do those types of things with an IRA because it's much easier to keep it passive, keep it arm's length. And, if I own a crappy rental property, somewhere in a not so nice part of town, but it cash flows, I'm not going to want to go stay there. Sure, I'll do that investment in my IRA. It just kind of depends on where the personal needs are at the time.
Well, because if the IRA owes that asset, all
Mhm.
expenses have to come out of that IRA, and that's where it can get
Exactly.
real complicated if you're not
Yes.
doing it correctly.
Oh, yeah. And you want to make sure you're doing that correctly. At Quest, we make it as easy as we can on our clients because the easier it is on our clients, the easier it is on us. So, through our client portal, we actually have a feature where you can upload bills and expenses directly to the portal, and we'll send that payment out in 24 to 48 hours. Say if it's like a reoccurring bill, you could send it to us once, click a button, we can set it up to be reoccurring as we receive that bill every month or every year, whenever it might be. So, yeah, it can be difficult. And this is where I also kind of give some caution to partnering your own funds with your IRA. If you're looking to like buy a piece of real estate and you want to partner your own funds with the IRA, it can be done. But for all of those petty little real estate expenses, they have to be split based on those percentages of ownership. So, private lending, much more passive, much easier to partner multiple people or IRAs in there. Whereas if you're actually owning the real estate in an IRA, you really want to make sure you're fully thinking of the full picture when you're looking to partner multiple parties in on that deal.
Yeah. So as we wrapping up, do you have maybe 3 takeaway that you can share with the audience?
Yes, definitely. So, first and foremost, everyone out there should have a Roth IRA, whether it is self directed or it's in the stock market or it's in mutual funds, whatever you want it invested in. Open up a Roth IRA, max out your contributions as much as possible. So, you are taking advantage of that tax free growth. Um, I mentioned that there's an income limit on Roth IRAs whenever you make contributions. There used to be an income limit on the ability to do a Roth conversion. So prior to 2010, if your income was over those phase out limits, you just flat out could not have a Roth IRA. But in 2010, they took the income limit off of the ability to do that Roth conversion. So now everyone can have a Roth IRA, even if you can't make a direct contribution. But the reality of it is, one, taxes are probably going to go up in the future. It's inevitable, especially for, people like us. We have a long time until retirement. Taxes are going to go up in the future. Also, we never know when legislation might change. There's nothing that I know of right now that says they're trying to get rid of the Roth IRA or put more limits on it, anything like that. But all we know is how the rules and how the legislation is today and how we can best maximize that. So, who's to say that they won't in the future put that income limit back on the ability to do a Roth conversion? So, just kind of that's a key takeaway. I always like to put that towards the end of my presentations, not to scare people, but just to kind of, get it in your head, get you thinking a little bit because, you want to take advantage of this at least while we for sure have the ability to now. Second takeaway, I did not get a chance to talk about this one too much, but the health savings account. I'm going to spend a few minutes to talk about this one because, besides the Roth IRA growing tax free, the HSA or the health
Mhm.
savings account is one of the most powerful types of accounts that we have at Quest. First of all, it's the only type of account that when you make a contribution, it is tax deductible and the money comes out completely tax free as long as it is to pay for your qualified health expenses or to reimburse yourself for qualified health expenses that you maybe have been paying for out of pocket. Now, it probably hasn't fully kicked in yet. That is huge though, because say if I have an HSA, I start it today, and I have a really small amount in there. Maybe it's only like $2,000. So I have my HSA in place. I'm investing it, I'm growing it. Meanwhile, I am paying for all of my health expenses out of pocket. I'm keeping track of those expenses from year to year. As
And you
long as
can
the
grow it the same way you grow all your
Yes, it
Like
can be
how we talked
self-directed.
earlier. Okay.
Yeah, and it can even be partnered in. So we see a lot of people partnering their HSAs. But this is where the real magic comes
Mhm.
in. As long as your HSA is in place at the time that a health expense occurs, if you end up paying for it out of pocket, you can come back at any point in the future and reimburse yourself completely tax free for HSA, regardless of your age. So, say me, Haley, 27 years old, I have my HSA, and over the course of the next 10 years, I pay for, say, something crazy happens. I pay for like $30,000 worth of medical expenses out of my own pocket. When I'm 45, I'm nowhere near retirement yet, but I could take a $30,000 distribution completely tax free from my HSA to reimburse myself for my health expenses I've been paying for out of pocket. That is
That is
huge.
powerful.
Very, very powerful. Um, you know, not to let you guys down a little bit, but there are some things that you have to, some qualifications you have to meet in order to be eligible to make a contribution to an HSA. But for a lot of you who are self-employed out there who are getting your own health insurance, look into getting a high deductible health plan. You have to have a high deductible health plan in order to be eligible to make a contribution to an HSA. Now, if you have an HSA and you no longer meet, you no longer have a high deductible health plan, you can still use your HSA. You can still invest it and grow it, but you have to have that high deductible health plan in order to be eligible to make contributions. That's the main one. You can't be a dependent on someone's taxes and you can't be on Medicare, but the main one really is that high deductible health plan that will determine if you're eligible most times to make contributions to that HSA. So
That is
that's
super, super powerful.
yeah. So that's takeaway number two. Takeaway number three is, guys, especially as we move into the new year, I know a lot of times in the new year, we are goal setting. We are looking to the future. We're setting our goals for the year, the next 5, 10 years. Take a look at your retirement portfolio. Take a look at the way your account has been growing, and then ask yourself, by the time I hit retirement, is this going to be enough? Now, the scary thing is for most Americans, it's not. The way
That's
we've
sad.
been traditionally taught to save for retirement, contribute 10%, your employer will match that 10%. By the time you're 60 years old, it's white sandy beaches, right? That doesn't always happen. A lot of people have either taken distributions, especially this year, maybe you never
Mm.
started.
Yep.
It's never too late to start. There's no amount too small to start. In 5 to 10 years, if you don't get started now, you're really going to wish that you did. So that's probably one of my biggest takeaways. No matter where you have your retirement account, whether it's more traditional at Fidelity, Charles Schwab, somewhere like that, whether it's self directed, make sure that you're planning and you're looking at your long term goals of where you want to be, and do the investments, hold the types of investments in your IRA that's going to get yourself there. You don't have to do 20 investments in 1 year, but get started, get the ball rolling, come to our classes, come to our webinars. Subtle, not so subtle plug. I host a virtual networking happy hour on the first and third Wednesday of every month. We are getting about 50 to 70 investors joining us every single month. And it's people from all across the US. So first and third Wednesday of every month at 6:30 p.m. Central Time. I'll send you the link for that. We can include it in the description. But that's a great way
You.
to network with people that have deals, people that have IRAs. And it's really created this little community of us from all across the country that are IRA investors that talk about different topics every single time we have this happy hour. So get started, leverage your network, get the education, and figure out how you can build tax free wealth by investing with the people around you, using those good resources. And last but not least, never forget to do the due diligence, because Quest will fund the deal, whether it's a good deal or a bad deal. That's not up for us to determine. Do your due diligence, do things properly, use professionals, and take advantage of this awesome resource that we have. It's such a powerful tool. You'll actually laugh at this. So, quick story. My first day at Quest, my parents have been clients for a long time.
Yeah.
Not gonna lie, when I got my credentials, I got my login, I could now
Uh-huh.
access everything. I was like, okay, Eddie, Debbie, what are we working with here? And to be honest, I was shocked at how much they were able to build up their IRAs. And, at that time, just over 10 years of being Quest clients, they were not young when they started their IRAs at Quest. I was
Yeah.
already like, in, I guess, kindergarten. I was 10 years old. So, and they've been able to grow it pretty substantially in ways that you could never do through traditional means of investing. So, it's possible, use the right resources and don't delay it because you're just missing out on potential growth there.
I'm a big believer because I had my traditional IRA, and then I, yep, of course, move it over to Quest and convert
Mhm.
it to a Roth, and I was able to grow my IRA, I would say 400 times,
Yeah.
you know, just and doing real estate deals.
Mhm.
So I'm a
That's
big
awesome.
believer.
Well, we'll have to bring you out for some case studies then. You're asking me about deals. I want to hear about what you've done. We'll have to come back
Yeah,
for
happy
another
to.
edition of that.
Happy to. So
Mhm.
let's wrap it up, and I'll ask this questions to every guest I invited. What's your favorite hobby?
Oh my goodness. I have a lot of hobbies, especially like with quarantine and everything. So I know the houseplant trend is all over the place right now. I got into houseplants just before this trend started. I love houseplants.
I
My
got
house
my
is a
one plant
jungle.
too. See that?
Yeah, oh my gosh, I would show you, but my office is a mess. I have like 10 plants in my office. I think we're up to about 150 total. So if any of you guys need not just IRA education, but if you need to know how to keep your plants healthy, I've got you. Um,
Okay, I need you over here to keep my plants healthy.
right? Yes, but we are also super into aquariums. So we have now 4 aquariums of all different sizes. I went out of town this week and I came home and we had 10 more fish in one of the aquariums because my boyfriend
Wow.
got a little bored this weekend while I was gone. But we are also starting a new business venture of building custom ponds and water features for people here in Houston. It's my boyfriend's passion. We've been following how to do this for several years now. And so we actually have a pretty big koi pond in our backyard. And he's going through classes right now to become a certified aquascape contractor. And, so if you guys in Houston need a pondless waterfall, rain retention, just water features in general, where the goal is to be Houston's premier pond builder. So check back with us in a couple years. We'll let you know how that's going.
That
But
is very cool.
it
Are
keeps us
they
really happy. Yeah.
yeah,
Yeah,
your
it does.
aquarium, are they salt water or fresh water?
No, so we haven't moved up into saltwater yet. They're all freshwater, but they range. We have a little shrimp tank that's growing shrimp like crazy. We've got some betta fish, and then we have our big 40-gallon with some other more aggressive fish in there. And then the pond, which is it's so relaxing. The sound of water out there. I'm working from home right now. I'll go out and I'll spend a few minutes out there with the dogs and just enjoy the sound of the waterfall. And it's nice. It keeps you really happy.
Yeah, I'm actually very impressed. I saw your pond picture on Facebook. Very
Yeah.
impressed. Yes.
Yeah, it's awesome.
Okay. So, lastly, how does the audience get in touch with you and learn more about you?
Yes. So our website is such a great resource. Send us an email, IRA specialists at questtrust.com. Be sure to tell us that you found us here on the RE Ballers podcast. We always like to know where you guys are joining us from. But we are actually in the process of revamping our entire education tab on our website. Actually, by the time this airs, it might be live. If not, it'll be just another week or two. But our website is such a great resource. We believe that our most educated clients are our best clients. So we are always actively working to improve that education on our website. If you go to questtrust.com, you can see all of our education. You can request a free appointment or consultation with an IRA specialist. And if you go to our website during our business hours, you can actually chat live with an IRA specialist right there through our website. It is super easy to get a hold of us. And certain days of the week, you might actually catch me on there.
Well, that's all for today's episode of the Real Estate Ballers Show. Thanks for watching, and thank you, Haley, for joining me today. Don't forget to visit our website at reballers.com to learn more about us. If you found value in the show, we appreciate a thumb up, or if you simply tell a friend about us, that would help too. And please hit that subscribe button so you'll never miss another show. We'll see you again in 2 weeks.